Welcome everyone, I'm Andrew Thompson, General Manager of CFMG Capital, and welcome to another episode of Smart Capital. Each month we sit down with an expert to explore a topic that impacts investors and deliver practical insights to help you on your journey towards financial freedom. In this episode we're going to be diving into the role of private credit in your SMSF, what it is, how it fits into a diversified strategy, and practical steps trustees should consider when thinking about private credit. Joining me today is Clive Todd. Clive is an accountant and financial advisor and specialises in superannuation, self-managed superannuation funds and wealth management. We've had him a few times as a guest speaker at our regular CFMG Capital Q&As, and he's always a very popular guest with his encyclopedic knowledge of the SMSF space, strategies and understanding of the very, very frequent changes in legislation in this space. He is a partner at Exant Advisory, a full-service Brisbane-based accountancy firm with over 150 staff, where he has been their expert on all things SMSF since 2009. Welcome, Clive.
Thanks, Andrew. Great to be here and talking about something close to my heart, which is obviously superannuation and the burgeoning investments in private credit within that area. Just a quick bit about me. I've had over 25 years of working in superannuation and specifically self-managed super funds, starting, as Andrew mentioned, at the first iteration of our firm in 2009, Henrik Curran, and I've been there ever since. About 5 years ago, branched into financial advice and became a licensed financial advisor just to be able to help clients fill in those other gaps that I couldn't do as just an accountant. So now it's all about helping clients with their superannuation, their retirement goals, and the strategies and investments to help achieve that.
This is just a general discussion. No, Clive's not giving anyone advice, so make sure you talk to your own trusted advisor, and I'm certainly not giving you any advice either. So I guess just for our new guests, we're using some, not slang terms, but some general terms, just talking private credit this, private credit that. So I just thought I'd give a quick summary on private credit and what it is as a bit of a refresher. It has grown exponentially in previous years or recent years. The estimates now put its total value at over $200 billion. And if you've been following the news, the spotlight is well and truly on this space. And in our previous episode, we talked about that spotlight and regulations and compliance, and we welcome that spotlight where we feel we're ahead of the game. As an asset class, it's got a long history, but in recent times, it's become more widely available to retail and self-directed investors, particularly SMSFs. Its attractiveness of private credit is easy to understand. It does have solid risk-adjusted returns, and diversity and access to previously inaccessible markets. And what I mean by inaccessible markets, it's now, due to its growth, it's more widely available to the retail investors, and particularly in combination with the growth of SMSFs in the same sort of period, your average everyday Australian with an SMSF has a lot more investable capital under their control that they previously had. And as a result, it has been a core strategy of many self-directed or advisor-directed portfolios because it can produce income across pretty volatile cycles. I guess my first question for Clive is, why would you consider, or what would your comments be on private credit and where it might fit in an SMSF?
Yeah, well, what I'm seeing, and I've got the benefit of wearing the two hats, where I see looking after SMSFs that are purely self-directed, so the trustees making their own decisions, but then I'm also putting the hat on as a financial advisor and making recommendations around the investments they should be putting into their portfolios. And I think I've seen the rise in private credit in SMSFs in the last few years, or in recent times, around a period of low interest rates. There was a bit of a drive towards people seeing headline returns and obviously jumping into there. So a lot of my discussions over the last few years have been with people around that understanding of what it actually is. It isn't a bank deposit. There is risk involved, and that's why you are getting the returns that you do receive. But I think it's that income achievement that people are getting when you get into your retirement phases in superannuation and you're drawing down on your benefits, you do tend to look for income producing assets because that you don't want to necessarily be selling down equities or illiquid assets at a time that might not be ideal. So income producing assets, I've seen that's one of the main reasons people are obviously going to it. And that diversification, I think some of the education I've tried to do with some of my clients is around not just understanding private credit, but most people in Australia are comfortable investing in property and wouldn't even think twice about that. But they then have a slight hesitation around investing in private credit, first because they don't know what it necessarily might be and the risks involved, but they haven't pieced it together that, well, if you're comfortable with property, private credit's another way of potentially accessing exposure to property-based investments. But it comes with that, I guess, security of knowing you're getting a set return, and there's that preservation of capital as well.
Yeah, I mean, look at funny what you're saying at the start there is one of the great ironies in the growth of SMSFs. And as we know, SMSF is Self Managed Super Fund, but most of the growth in Self Managed Super Funds is people setting up funds to be then advised on what to do with them. So they're not really self-managing them at all. But that's another rabbit hole to go down. But what strategies suit those clients and what types of private credit? And that could obviously depend on the client, what their total capital is. But just sort of what are you seeing in that space?
Yeah, well, there's definitely a horses for courses. There's no one size fits all, and it does depend on the circumstances of the client. Like what a 40-year-old might be looking at to invest in is going to be different to a 70-year-old. And key to anything we tend to sort of talk to people about is diversification. And that's not just necessarily across asset classes. That's even within your private credit. And as you sort of mentioned, Andrew, like there's different types of exposure in private credit. There's obviously the property based, which is still predominantly what the Australian market is. But when you look into the global market of private credit, property would make up a small percentage. It's more of that corporate and that business private credit focus. And the Australian market, as you would know a lot better than I do, is still a burgeoning area in private credit, and we're still probably in our infancy. I think the amount of money is growing exponentially, but it's still got a long way to go. So I think when people are assessing whether they are wanting private credit in a self-managed super fund, it's then not just a particular type they should be looking at. They should be ensuring they understand the different types available, and if they're comfortable with a property-based one, then look at the managers involved.
I'll move on to the next sort of question I've got for you. How should trustees, I guess, assess the suitability of private credit or different types of private credit?
Yeah, well, I think as I sort of alluded to earlier, private credit, a lot of the focus should be around the capital preservation. Private credit tends to be assessed by, not having losses as opposed to that capital growth that you might be expecting in equity-based investments. So when you come in to look at managers, track record in the private markets, and that includes private equity and private credit, tends to be important. There's the old cliche of past returns do not guarantee future returns, but in private markets, it does tend to give more of an indication. Private credit managers will tend, if you've got a good track record, you will tend to most likely get better opportunities, better deal flow, and hence that flows through to the clients, and the investors. So I think track record is obviously important. Governance and transparency, and you would have talked about that in previous podcasts, I believe, but that's the one area where Australia is probably a little bit murkier and more opaque than potentially some of the overseas markets, but good managers tend to be forthcoming with that and how they're making their decisions. And what I tend to sort of talk to people about is just ask, like, do they have losses? Has there been situations and loans that have gone bad? And what was the learnings from those? And what did you do to recover? Because I think that liquidity component is still key. Going back to that asset allocation as to why you'd be allocating and how you would be allocating to private credit, I do tend to harp on about diversification because a particular investment you might be thinking it's a term of 3 years, 5 years, but you get to that point and it might not be. So if you put all your eggs in the one basket and you're relying on that capital to fund your pension or another investment, then you might find yourself in a bit of trouble at that point. So you've got to be careful around that liquidity requirement and not necessarily just assume that's going to happen.
Yeah, I mean, as we've sort of alluded to, change is definitely coming in that space. Particularly, from our perspective, we feel that there's a real grey area in that sort of wholesale only space where the disclosure obligations, if you're protected, in inverted commas, by the sophisticated investor defence, you almost just issue a couple of page document and take their funds and off you go. Whereas if you're holding a retail license, you're issuing product disclosure statements. There's a whole lot more regulation in that space, but there's certainly that can improve more, and the regulatory authorities are certainly making those changes as appropriate.
I think the fact with private credit being available to more retail investors is a positive. Like you talk about the wholesale market, and for probably a long period of time, it's a opportunity that certain people in the country get exposure to, and others don't. And that's where the benefit of a self-managed super fund, now they're starting to be able to get access. They don't need to necessarily meet those wholesale requirements, but they can still be getting access to an asset class and get more choice around that asset class than what they would have previously had.
Yeah, and I think, it's a self-serving position, obviously, but your comments around track record, like, we couldn't obviously agree more. And as the old saying goes, as you pointed out, past performance is not a reliable indicator of future performance. I would certainly argue it's a bloody good guide.
Yeah.
But we think our track record, which, I'm on record, pardon the pun, that we have got 100% performance over nearly 20 years, and we think that's a really critical part of our business going forward, and something we're both proud of, but it's also critical to our performance as a business, and ability to attract further capital. So, it is important assessing, is a private credit potential and somewhere where you're looking to invest. Are they just a middleman that's lending out to businesses all across the spectrum? Are they lending, sometimes diversification is good within your own portfolio, but if you're giving your money to a asset manager, perhaps you want them to be an expert in managing the assets within that field, as opposed to someone that's just spreading their funds across 20 different asset classes, and they're an expert. The old saying, a master of all trades, but a champion at none, or a master of all sports and a champion at none. So, all things to consider. You can chase expertise, and again, somewhat self-serving. We're experts in residential land subdivisions, nothing else. So we don't invest or deploy capital in any other area, whereas there are other funds that might be across retail property, commercial property, industrial property, residential property, apartments, and everything in between. And it's just a matter of assessing those opportunities and coming up with what best suits your strategy.
Yeah, and I think that's a good point around trustees making decisions. They're making their decisions at a point to say, I want to be allocating X amount of my portfolio to a particular asset class. So they're not necessarily then wanting the fund manager to go and change that mandate and try to do everything, because they might have already invested, well, like you say, to industrial property over here. They've got their residential property via CFMG or a similar one. So those decisions have already been made. So I see it sometimes when fund managers try to cross those lines. We touched on briefly around that diversification from industrial and residential. Something that probably doesn't get much mention in my world as it should is geographical. Like,
Yep.
You're an investor in Brisbane and you own a residential property in Brisbane. Then you go buy another residential property or get exposure to the residential market in Brisbane. It's actually the same. So I've had some discussions with clients that go, no, I've got plenty of diversification. I've got a property at Graceville, I've got a property at Nunda, and I've got a property at Aspley. And they're going, well, that's still southeast Queensland. Not even just Brisbane. So private credit is an opportunity to suddenly get exposure to property in Victoria or Western Australia or a whole nother market without buying a property necessarily as well. But you're part of that, I guess, geographical property market via that exposure.
Yeah, I mean, people are quite capable of operating in a vacuum. They see their local real estate market as really, really strong and just assume the whole country is strong. Certainly us, wearing both hats as a fund manager, asset manager, and a residential land developer, we obviously see complete opposite. We've been heavily weighted to Brisbane for some years now, and that's not because we're Brisbane based. That's because we feel Brisbane's the strongest market. The Victorian market, for example, has been post-COVID boom really quite slow. There's oodles of residential registered stock still on the market down there. Queensland right now, South East Queensland's got about 3 months worth of actual supply in total, and none of it registered in the market. So supply is not even close to meeting demand in South East Queensland, whereas in Victoria, supply is exceeding demand. So we operate across those cycles, and there's no doubt at some point in the next decade that will turn. We think Brisbane's got plenty of time to run, but Melbourne is going to bounce back. It always does. Sydney's kicking along quite nicely. We're now investigating Perth, but every single one of those markets is operating differently to each other, and you can achieve significant diversity by getting exposure across those 4 markets, among others. So, yeah, it's a really good point you make. I guess probably the next one and the touchy topic is what are the main risks, or what risks should trustees look for or need to understand about the private credit space?
Yeah, well, as I say, private credit should be focusing on capital preservation, and there is that manager risk and that liquidity risk involved. So it is definitely understanding what you're getting into and potentially the timeframes around when you might get your capital back. It's all great to be getting that return, and you would hope that would continue, but it is a case of going, if I'm expecting to get my capital back in X period, am I going to get it? What's my how would I deal with the fact if I don't get it back within that time? Have I got sufficient diversification? Now, the risks I see in some of the managers and that, and obviously this has been talked about at length in the media, is obviously some of the practices and the valuations that people are applying to some of the underlying assets that people are lending money against. And property is obviously the big one there, because it tends to be obviously bulkier assets. Like if it's a more of the smaller asset backed private credit market in cars and planes, etc., there's probably less of a valuation issue. But properties, you want to make sure that they're valuing them accurately, and the methodology behind those valuations,
and different levels of liquidity as well. Even across the development space, for example, or the property space. You might have a commercial office trust. Yep. If you've got a $80 million Sydney CBD commercial office asset, if the commercial market's not strong, it's not something you can just go and sell to the bloke up the street, an $80 million asset. Equally, you might be exposed to an apartment development. The market turns, they're half built, there's construction risk, builders pricing are going up. And you've got a half-built project. There's no liquidity in a project like that until the building's finished. Whereas, again, using residential land as an example, obviously, you can stage a residential development into small bite-sized chunks. You can, no easier or harder, I guess, than selling a large commercial asset, but you can sell an englobo parcel to realise some value quickly if you need to. All different levels of liquidity within the same space. Apartment development is a critical part of solving the Australian housing crisis. So I don't want to suggest that we shouldn't be building apartments, but just by the nature of apartment development, the time it takes to construct and the ability to realise value until it's actually physically completed, that's probably the most illiquid opportunity you can get into, versus somewhere in the middle, commercial, retail, industrial office space, and then at the other end of the scale, residential land, which, as I said, can be broken into bite-sized chunks and can be traded, at almost any time through the development cycle.
Well, just touching on some of the compliance then around that decision-making for trustees, there is a requirement for trustees of a self-managed super fund to have an investment strategy. And I think that should always be considered. And that's going back to what I said earlier. The decision-making for a 40-year-old will be different to someone moving towards or in retirement. And that should be considered as part of the overall fund investment strategy and documented as such. Now, part of that is liquidity. Part of that is obviously risk versus return. So again, somebody that's a lot younger and not looking to be drawing down their super can have a different focus and build that into their investment strategy, but it does need to be documented, and trustees need to, whatever investment they sort of make, they want to be able to sort of explain why they made that investment, how that was for the retirement benefits of the members, and just be ensuring that they are putting that trustee hat on. It's one of the key components of a self-managed super fund. I think that sometimes gets a little bit lost because trustees are the members. You do actually play two different roles, and trustees need to be making a decision with their trustee hat on for the benefits of the members, and not sort of with their member hat on, just going, I think this is a great idea. You also mentioned a bit about the related party side of things before, Andrew, like where somebody will buy a business property in their super fund. Well, conversely, with private credit, as we sort of said, it's non-bank lending. It's not a green light for trustees of self-managed super funds to just lend to themselves. That's not necessarily the private credit. There is rules and restrictions and regulations around any sort of related party transactions within the superannuation environment. So again, ensure that you are meeting those compliance obligations. There's severe penalties and hassles that you can sort of get yourself into, even at a personal trustee level, if you do breach any of the rules.
I guess regulatory issues, but these days with changes, constant changes, as you know, in SMSF space, what sort of tax issues should people consider, or matters relating to tax?
Yeah, well, I think, and touch wood, we've had a period of less changes. I won't say no changes, but less changes in superannuation over the last few years, as I think the focus has been on the new proposed Division 296 tax, which is that tax on individuals with more than $3 million in super. Now, that's currently just finished receiving sort of feedback, etc., from the community, and the government will obviously be looking to push that forward. But the big shift there in that tax is it was originally proposed to be effectively taxing unrealised gains. Now it's moved back into just being an additional tax on taxable income. Now, I won't go into all the details around that because it's potentially quite a complicated tax, and it'll be interesting to see how it's actually applied in practice. But for individuals, for people making decisions about their investment, I think it's going to be a case of focusing now back on that taxable income. So if you are in that situation where this tax will impact you, it's, I guess, firstly, the reassurance around it's not going to be unrealised gains, but it will be on taxable income.
I guess we probably should get close to wrapping it up. Probably the final query for you is, I guess, what is the single most important takeaway for an SMSF trustee who's considering private credit? I guess, summarise the position.
Yep. I think, firstly, as I said before, it's not a bank deposit. There is risk involved. So understanding, ensuring you do your research, talk to either your advisor or the manager that you're looking to invest with, understand what it is that you're getting into, and then ensure that it fits within your investment strategy. There's no good investing in any investment that's not going to meet your investment strategy and result in either not the return you wanted or liquidity issues at some point. So definitely be considering that, and do unfortunately factor in potential changes. Like if there is a legislative change that's then going to result in an additional tax, you've got to ensure that you're able to fund that. And that was one of the issues with that previous sort of first iteration of the legislation, is how these things were funded. So I think trustees just need to make sure that they know what they're getting into and how it will impact them with any future changes.
Yeah, I mean, something we see sort of, and not just through my involvement in this business, but what I see out in my, same thing, like barbecue conversations, things like that. People still, unfortunately, are really apathetic to their retirement future and their superannuation. Even those that have gone off and set up an SMSF and wanting to sort of take control. Once they've set it up, they don't then actively manage it. Some people almost treat it like a bit of play money, and they're just far too apathetic to what they do with those funds. And like a really simple piece of advice, pardon, not want to use the word, but just read the PDS. It's extraordinary how many people that I encounter, not through this business, but in general life, that have invested in something. There's a document they consider long and boring, and they haven't even read it. And then they might get a shock 5 years down the track, and it's like, well, it's right there on page 3. So just make sure you read all the available information that's given to you of part of any investment. It sounds like a simple thing, but just doesn't seem to compute with a lot of people.
Yeah, in Australia, we are lucky that information is freely available. It's all there. Just take advantage of it. And like I say, we still have the ability to talk to licensed advisors that don't necessarily listen to the barbecue chat. Get your own advice, and that is important.
Yeah. Well, thanks, Clive. As usual, been a pretty insightful discussion. For the first time ever, I haven't, when I have Clive talk or present, I'm writing down 50 notes and running off to my nearly retired parents, giving them advice on the various changes that'll help them. But this time around, no new regulatory changes or no new things that I didn't know about, touch wood, that will impact our super. But it's still just good discussion about how private credit might fit into those SMSF portfolios. So thanks for coming on, mate.
Thanks for having me, Andrew. It's been great to chat, and can talk all day about superannuation, as you know. So, but I'm happy to sort of help out anytime.